But and I thank you. It's an interesting one that you have taken a liking to in this instance, because I remember a couple of months, maybe a month or a month and a half ago, I had an interview with a gentleman from Rand Merchant Bank, and he has come up with what he calls the milk index. You guys have gone on the Coca Cola index. Let's begin with the methodology here.
Okay, so it's a similar approach to the Big Mac index. Of course, the Big Mac index uses the McDonald's burger. But we thought that in Southern Africa, let's look for something that's quite common across, sub-Saharan African countries. So we've used 7 countries. So we then decided to use the price of a 2-liter Coca-Cola PET bottle. So what we then do is that we then come up with the USD prices across the various, countries, and then divide that by the price of a 2-liter Coca-Cola in the United States of America. So the measure really sort of gives you some implied exchange rates that you then use to then compare with the actual exchange rates, gauge whether a currency is overvalued or undervalued. However, for our case, I think it's quite critical in the sense that it then gauges things such as buying power and productivity.
Yeah.
And what we see, especially in frontier markets such as Zimbabwe, which is where we focus most of our research on, is that the exchange rate actually looks undervalued. Given, of course, pressures on the pricing front. So you find that, operators such as your Delta would actually be limited in terms of actually increasing prices on Coca-Cola. So it really shows you how, the differences across buying power and GDP per capita.
Yeah, it is interesting, isn't it? It is very interesting, as you say. So you found, for instance, things in Zimbabwe that there is an undervaluation of the exchange rate, I think, which is no surprise given the flawed fundamental economic issues that you are having to deal with there. But I just wanted you to quickly go through the results of what you found in terms of the valuation of the currencies, as well as the productivity in the different Southern African countries. I suspect you may touch off a diplomatic incident here by suggesting some countries are not more productive than other countries.
Yes, on the production front and also on purchasing power, you find that Zimbabwe is is on the low side. So you find that countries such as South Africa, Namibia, where GDP per capita is actually quite significant. You find that the undervaluation in terms of the percentage is actually lower on that front. But in Zimbabwe, we are looking at an undervaluation of about 50%, which shows you again the issues of purchasing power. But however, in practice, if you're looking at I think you highlighted the milk index and other measures. You find that in a lot of these African countries, their currencies are actually overvalued because there's a tendency by governments to try and control the exchange rate, given of course the idea of managing inflation. So really, in our case on the Cola-nomics front, I think the key takeaway is on purchasing power, productivity, and the differences that exist across the country.
And in terms of productivity, who's the most productive in Southern Africa?
So you find from our taking, you find that Namibia and South Africa would be more productive than your Malawi and countries such as Zimbabwe.
Yeah, I don't know what's happening with our sound there. Hopefully we can fix that before we end the interview. But I'm certainly hoping that you beef up your security, because Zimbabweans and Malawians are going to march to your gate and say, how dare you suggest that we're not as productive as the South Africans. But I wanted to argue with you a little bit, and you did touch on it in your answer to my previous question, the issue of the valuation of the exchange rates. Some would argue that perhaps that methodology is a little flawed, because you are dealing with exchange rates that are largely fixed apart from the rand, and therefore what you are using may well be data that is not accurate nor reflective of the real fundamental value of the currencies of the countries that we're talking about, other than South Africa and Namibia by extension, because the Namibian dollar is tied to the rand.
Yes, I think there's already, some questions around that, but there's always need to make adjustments. And As I indicated, our key takeaways really are more around purchasing power and productivity, as opposed to coming up with a hard rule on the like the implied exchange rate. But really, it then helps you in terms of the pricing dynamics and also understanding productivity levels across the different African countries.
Absolutely. So you indicate it as an indicative tool. While we are with you in
Yes.
Harare, let's talk about things economic on the Harare side of the market. How is the market reacting in the aftermath of now what appears to be an extended mourning period for the former Zimbabwean president Robert Mugabe, and of course the continuing headaches on the economic front for the government of Emmerson Mnangagwa?
Yes, so the key economic event that has come through has been the monetary policy statement that was issued on the 13th of September. The key highlights in the statement are that, there are a lot of pressures within the broader economy. I think there is a focus on a budget deficit and also current account deficit because of developments on the ground. I think the major cause of concern has been around inflationary pressures. I think in terms of targets, we're seeing focuses of about 500%. So we are really in hyperinflation. Productivity levels are quite on the low side, capacity utilization around 38%. So there are a lot of concerns that the economy is actually not growing. And some of the measures that we have been put in place, for example, increasing the RBZ overnight rate from 50% to 70% is counterproductive, especially for companies that need to produce. So there are a lot of concerns around, growth and also the issue of inflationary pressures.